Earnings season is now in a powerful full swing. And like we do at the beginning of every reporting period, it's time to catch up with the first major group to release its quarterly results. And that's the biggest banks. They are important. Normally do this because the banks give us a great read on the broader economy. But now we need to take a more bullish approach because this moment is perfect for the mainstream banks. Okay, it may not be good for a lot of these high-flying pre-revenue companies or even entertainment companies, but for mainstream banks, nirvana. These stocks actually held up in the vicious last hour selling onslaught because they're making so much money. We always hear about how rapidly rising interest rates are bad news for the stock market. That's true, but not the part of the stock market that's the banks, because they can make more money on the difference between what they pay you for your deposits and what they charge you for loans. That's that net interest margin thing we talk about. They'll keep paying you more or less, the same old crummy rate for your checking or your savings account, then turn around and take those deposits and make a fortune with them. Even though I think 2022 looks very good for the financials, there's no denying this has been a pretty choppy week for the six majors, some of which the market loved and some of which the market hated. And it's not the usual suspects. Last Friday, for instance, when Citigroup, JPMorgan, and Wells Fargo reported, we saw something really strange. Wells Fargo, formerly the problem child of the group, actually managed to rally. While Citigroup pulled back, okay, nothing new there, but the once loved JPMorgan sold off and sold off hard. There's a reason we own Wells for the charitable trust. After the long weekend, we heard from Goldman Sachs on Tuesday morning. I liked the quarter, but Wall Street disagreed, and I didn't push harder. The stock plunged 7% in a single session. Then yesterday morning, we got results from Morgan Stanley and Bank of America, both of which did better. Their stocks initially rallied substantially, but then the whole market rolled over, and a big chunk of those gains got repealed, as you saw. In short, while this could certainly be a good year for the banks once the Fed starts tightening, in the first earnings season of 2022, the group has been all over the place. Let's take them one by one. Let's start with Citi. When CEO Jane Fraser took over the Citi a little less than a year ago, I guess in retrospect, the bank may have been a bit of a mess. She set out to streamline the business, get back in the regulator's good graces. Unfortunately, still too early to tell. Work in progress. When Citi reported, the headline numbers were better than expected, but Wall Street was not impressed. Why? Citi's expenses. They were too high, up 18% year over year, even though its revenues were only up 1%. Well, that's a bad mismatch. The best thing you can say about this one is that its stock's cheap. It's trading at roughly 80% of its tangible book value, which is what the bank will be worth if you liquidate the whole business tomorrow, though, of course, we don't do that. This is crazy cheap on book. But that's nothing new. I also like that they're finally rationalizing the worldwide network rather than losing money in a gazillion different countries. Even then, though, Citi can't capitalize on that cheapness. Why? Because they had to pause their buyback in December because of regulatory issues. Now, Fraser says the repurchase will resume this quarter. Maybe then the stock can turn around. Do you mind if I wait? Next up, the biggest shocker of the bank earnings season, JPMorgan, long considered the best of the big banks. This time, though, Wall Street was, let's say, very disappointed. Even though the headline numbers were fine, their expenses were up 11% year over year, far outpacing the 1% sales growth. Worse, CFO Jeremy Barnum had some cautious commentary on the conference call, talking about how they're looking at a couple of years of sub-target returns. Why? JPMorgan stepping up its investments in the business in order to reassert their dominance against some of the, some of the other banks, also, but the smaller financial tech players that have been running circles around most of the majors. I didn't want to hear that. I didn't want to hear it because, this is a company that's really cut expenses, but maybe they cut too much. CEO Jamie Dimon sounded like he wants to bury all the fintechs when the grass is moving to the cloud. Better late than never. But it's going to cost them an arm and a leg. It's always my favorite. Not anymore. Instead, the magnitude of these investments took people by surprise, which is why JPMorgan stock got annihilated in response. In just 4 days, the market capitalization now shrunk by $60 billion. I think it actually deserved to go down some, but not this much. We're only talking about $6 billion increase in expenses next year. After this decline, JPMorgan trades at just 13 times earnings, though it's the most expensive of the group on its book value. You know what? You can do better, but it's come down. What is better? How about Wells Fargo? It's like the old days. Yeah, we like it so much we went for the charitable trust, as you know if you join the CNBC Investing Club. Wells has been the best performing bank for a while now because CEO Charlie Scharf, whom I like personally because he's done a fantastic job, has executed masterfully on the turnaround. This time, Wells Fargo delivered a big top and bottom line beat with 13% revenue growth. Woo! Non-interest expenses were actually down versus the previous quarter and double digits versus the previous year. Most important, Wells is very sensitive to interest rates, so when you see bond yields surging, think Wells Fargo. This is something that we batted around just this very morning, and the Charitable Trust Research Director, Jeff Marks, on my new program, The Morning Meeting, that's plays every day at 10:20. This is for Investing Club members only, and we spent a lot of time in the morning meeting going over things like why Wells did better, and we concentrate on the stocks that we own for the trust, but we do them all. Today, by the way, we said, listen, we want to buy some semis too soon. Phew. Thank heavens. All right, next up, Goldman Sachs. Even though their sales were better than expected, the earnings came in substantially weaker than expected for a whole bunch of reasons, but they were still huge, and I love that. Yet the stock got slammed because people think they can't do it again. They can't repeat. They think last year's as good as it gets. As I told you over and over again, the bears say this every time, and they're always wrong. Goldman's one of the best franchises on earth, but it sells less than 9 times earnings, for heaven's sake. So you say, well, why don't we own it for the charitable trust? Well, as we said in our morning meeting, because Morgan Stanley exists. And I'm a big believer in diversification. Don't need to have 2 investment banks in your portfolio. Now, under the leadership of CEO James Gorman, this company has totally reinvented itself, going from a kind of a boom-bust operation before him to a much more consistent enterprise focused on asset management. This is looking less and less like a bank and more like a service company. On Wednesday, Morgan Stanley delivered a nice top and bottom line beat with a 6.8% revenue growth that outstripped the increase in expenses. We want that. At a time when everyone's worried about costs, these guys have excellent expense control. Meanwhile, the investment banking business is on fire, and wealth management's doing great too, especially on the asset management side. Oh, and they're aggressively buying back stock. What's not to like? Finally, also on Wednesday, Quizzical, Bank of America reported, I liked it, solid numbers. Revenue's basically in line, but the earnings came in higher than expected, though much of that came in from a big reserve release still. There were no negative surprises. Sales were up 10%, while expenses were only up 6%. They're very good, right? Exactly what the street needed. Better than the other guys. Bank of America is talking about holding expenses flat, unlike JPMorgan. That's very, very important when we try to figure out what's going to drive situation, and you can see what happens when they look at how much money they're making on this much revenue. It doesn't matter. The street was traumatized by JPMorgan expenses, not Bank of America. Bank of America is talking about holding expenses flat. Now, again, what this matters, just so you know, is they're a very digitized bank. These guys, not as digitized. That's what we're talking. Like Wells Fargo, Bank of America is highly sensitive to interest rates, which means it's in a great position for 2022. If the Fed raises rates 4 times, they're going to make $6.5 billion more than if the Fed does nothing. And it's risk-free to them. The only reason we don't own Bank of America is for the trust is, again, as we talk about in our morning meetings, we like Wells Fargo. Bottom line, the banks are all over the place this earnings season, which just goes to show you the importance of individual stock picking. All banks are not created equal. And when you get these big sell-offs like today, where everyone just says, woe is me, take a look at how well this business is performing. Tyler in California. Tyler.
Hey, Jim. Thank you for all the work that you do.
Oh, thank you.
What I wanted to ask is, when do you think would be a good time to buy Visa? You know, people seem to be itching to go out and spend, and, you know, summer will be here before we know it.
Right. That's a great question. Now, we own MasterCard and for the Charitable Trust, and Jeff Marks and I were saying that that's actually cheaper, better, and faster than Visa. So I don't want Visa's a good company. But if you want commerce and you want cross-border commerce, the best way to do it is with MasterCard. They are masterful. It will do really well when Omicron recedes. Susan in California. Susan.
Hey, Jim, long-time listener. Just want to talk about Upstart, which is something you were recommending quite highly a few months back.
Right.
Multiple times, and then it suddenly went like a number of stocks shot to hell. What is your outlook for this stock?
Well, as I said in our November conference call, what I said very specifically, and thank you for the call, but we said very specifically that we are done with the high flyers. Now we want to own companies that make a lot of money and do great things with tangible products. Now, Upstart is a profitable company, but it sells at a very high price to earnings multiple of more than 100. I think it will be fine, but it's not what's going to work right now. We're looking for companies that make things profitably. Wilmer, Missouri. Wilmer.
Yes, hello.
Hi. Wilmer, it's all yours. What's up?
Well, I was curious what you had to tell me what you think about FSKKR Capital.
Well, that's a very, I've been looking because it's a lot of stuff that's just kind of kicking around right now. This is new. New to me. I have to do this. I have not liked business development companies because I don't know what kind of loans they have. This is not Starwood, which I have a better handle on because Barry Sternlick is transparent. I guess what I'm saying is I don't know how they get that 11% yield, but I don't think I want to take the risk. I never reach for yield. Wow, surgical procedure thing. Wow. All banks are not created equal. Individual stock picking is the name of the game. Now, much more mad money yet, including my scoop with First Horizon, one of the banks that I expect to do well over the next year. Fresh off the morning's top and bottom line beat, getting rid of the regional bank with a CEO. And today, the French parliament declared the Chinese oppression of the Uyghur Muslim people a crime against humanity. So how could this news impact your portfolio? I'm going to give you my take. And all your calls rapid fire to tonight's edition of the Lightning Round. So stay with Cramer.